I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Anand Senior Tax Manager of Haines Watts, who are one of the top 15 chartered accountancy firms in the UK with over 50 local offices, where we continue our informative question and answer series on our YouTube channel to provide insights into helping buyers and sellers understand the benefits of using brokers for the purchase and sale of IFA businesses, and also from using accountants for sound tax planning advice. The title of the next video is coming up on the screen now. So Anand, we talked about limited liability partnerships, and first of all, let's just say the limited liability partnership, all of the members want to sell that business. Can they sell that lock, stock and barrel? And I'm assuming that's obviously they can, and they would all qualify for business asset disposal relief. However, what if just one or two of the members wanted to sell theirs? How does that change, and can they sell it to a third party, or have they got to sell it back to the existing members?
Yeah, it's a great question, and actually it's one of the areas in tax where it's actually there aren't too many requirements on the BADR position. So in the scenarios you've given where maybe half the partnership wants to retire, that's absolutely fine. They can either sell to the remaining partners or they can sell to a third-party investor, and the tax treatment or the tax approach is exactly the same. They're disposing of their share in the partnership. It's capital gains tax and BADR, again, as long as they've been in business, they've been members of the partnership for at least 2 years. And of course, this is a full proper retirement, where the business asset disposal relief rules, they can be a bit more technical, as if someone is semi-retiring, because you've got to show that you're really withdrawing from the business, and so in a retirement scenario there is no issue.
So again, a classic example, I suppose, there is talk to an accountant that fully understands what you can and can't do.
Absolutely.
Because then you have that extra protection, don't you?
Absolutely.
And certainly I think it's really worth saying that accountants that actually are in this space, that actually understands about the buying and selling of businesses as well, is really important.
Yeah, I mean, and what's really I think one of our strengths in the market, Haines Watts, we're a top 15 firm, and IFA businesses, of course, are specific and have specific issues, but ultimately they're owner managed businesses, and that's our sweet spot. That's what we deal with day in, day out. We've dealt with a number of clients who've sold their businesses in the last 2-3 years, even during the pandemic, ranging from furniture manufacturers to marketing to PR companies, all sorts of things. So it's the sort of thing we deal with when we do pre-sale planning. So occasionally you'll have the buyer wanting to restructure before acquiring the business. So there's all sorts of things that can go on, and it's all dictated by the commercials.
Yeah, and I think it's good though that likes of Haines Watts are very familiar with the IFA sector, because of course acquisitions are done very often differently than other industries, particularly with deferred payment process as well. So it's really important that there's that understanding as well. Yeah,
and by example, of course, we've got some IFA clients. One was sold pre-pandemic, 14.5 million turnover, up to like 1 million of profits, and it was sold for about 10 million.
Yeah.
So we've got people in that space, exactly, and we've got some current clients as well in that space as well.
So Anand, sometimes an IFA business will have other assets included within the company. For instance, they might own their property, or may have investments in the company, but an acquirer doesn't necessarily want to acquire those. So are there ways to extract those investments pre-sale so that they're excluded, or how does that work?
Yeah, I mean, great question. I think in those scenarios, actually what would tend to happen is you would probably take out the trade and assets part of it rather than the investment assets.
Yeah.
And something we frequently see is, as you say, an acquirer wants to cherry pick what they want to buy. They don't want to buy the investment assets. So often we'll suggest to clients to actually form a new company and hive down the trading assets to the new company, and then that new company being sold to the acquirer. And the reason you do that is essentially it's a tax-free disposal. You get what's known as substantial shareholding exemption from what was the trade co, and HMRC. Normally for that you need 12 months to do that, 12 months qualifying criteria in order to achieve substantial shareholdings exemption for the company. But actually HMRC accept that when it's part of a sale process, that's absolutely fine. So there you've got the acquirer acquiring a new company, fresh company, but with the trading assets in it. So it's almost the best of all worlds in that sense. Of course, what you've got left from the seller, for the vendor's point of view, is again you've got what was the old trading company now with cash in it. So we go back to the same issues we talked about how do you extract that cash, what are your objectives. Of course, business asset disposal relief is again going to be available to you if you liquidate. Again, this is all predicated. Any liquidation of a trading company is to achieve the BADR for liquidation of a trading company. Is predicated on you not starting a similar business within 2 years.
Okay.
So that is
and that's
always
a 2-year
something.
period.
It's a 2-year period, but also, as with most legislation, it's not just you; it's your spouse and it's connected people to you.
Yeah.
So, and when I say starting new business, that means you being a shareholder in a similar business.
This is where I sometimes see like 5% or above.
Exactly. So. So there's obviously starting a new company, but also starting a new sole trader, starting a new partnership. All of those things are caught.
Yeah.
So the liquidation process is really designed for people that are properly retiring and either doing something new or retiring and that's enjoying the fruits of their labour. So it was one of those areas of anti-avoidance that was put in place because actually it was quite attractive before to have a company as essentially a money box, accrue all the cash in it, and then liquidate it and get your capital gains tax treatment, and then just do it again. And just do it again. Yeah. So the government decided actually that was far too easy, so they put in these restrictions to say you can't just shut up shop one day and then start a new business doing the same thing the next day and achieve capital gains tax treatment. And one of the sort of stings in the tail to this is not just that if this does bite essentially and you set up a business within 2 years, not only do you miss out on business asset disposal relief, actually that liquidation payment is subject to income tax as a dividend. Wow. So it's one of those areas again that you just have to be very careful of if you are thinking of not quite retiring fully.
Agreed. It's understanding the rules, isn't it? That's so important. So Anand, on some situations here that you would expect an acquirer, when they're purchasing a company, to actually acquire it through a holding company, and that's often done particularly around capital adequacy, so that the goodwill is not deducted from the net worth and showing an insolvent position. Is this something you get involved with regards setting up holding companies, and tell me about the benefits of having them?
Oh, absolutely. So as part of Haines Watts, what we do is we're really end to end when someone's either buying or selling a business. We've got a lot of ancillary services. We've got solicitors in house. We've got corporate finance. We've got business advisors. So we can do the end to end on either the buy or the sell side. So absolutely, if you're working with an acquirer and they've said actually let's buy it in a holding company, we can facilitate that. As you say, you can see the commercial reasons why they would want to and actually need to do that. And so we would absolutely help them put the holding company into place and then deal with the acquisition part of it, as well as actually the due diligence part of it. This is something that we also do. We do the tax due diligence on some of our clients that they're looking to acquire targets. So absolutely we can provide full advice on those areas.
Yeah, and often what we find with acquirers that set up those vehicles is often then they will repaper those clients from their client fee agreements into their main entity, and then get the acquired company liquidated afterwards. So what's your involvement with the liquidation process, etc.?
Yeah, so from a tax point of view, one of the attractions of acquiring a company into a group is simplifying it, but essentially you've got potentially one holdco and a number of subsidiary companies, and again you get substantial shareholding exemption essentially when one of those subsidiaries is sold. So basically holding company doesn't pay any tax when either the shares are sold or there's a liquidation. So essentially what it does again is it releases cash into the business to then maybe acquire another one, or whatever is the objective of the shareholders. So in terms of the liquidation process, obviously as the name suggests, you would have to hire a liquidator in order to actually deal with the distribution of the proceeds. We work closely again with firms of liquidators in order to facilitate that for our clients. The process requires the liquidator to essentially understand the business, the assets, the liabilities, and essentially to attribute monetary values to those things. Sometimes things are distributed, sometimes assets are distributed in specie, sometimes they're turned into cash for distribution. The process normally takes, I would say at least 3 months, but really it depends on the complexity of the business.
Yeah.
If you've got, and especially in the IFA space, the levels of due diligence are going to be...
And I guess it's going to require the FCA to approve that liquidation as
Absolutely.
well. Of course, absolutely. As well. Make sure that you subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in this series. We provide insight into the tax planning benefits for an exit or acquisition of financial advisory businesses, as well as the benefits of using brokers by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA Acquisitions, and Anand Chandarana, Senior Tax Manager of Haines Watts, one of the UK's top 15 chartered accountancy firms.